Sunil Subramaniam, CEO of Sundaram Mutual Fund. He's joining us from Chennai. And Mr. Subramaniam, thank you so much for joining us. Let me start off with what is your sense in the overall space right now? Do you think that the markets are overall a little too expensive?
It's a perspective. If you're looking for, 6 months to 1 year perspective, yes, maybe it does look a touch expensive. But if you take a slightly longer perspective, say 2 to 3 year perspective, I think it's fairly reasonably priced. Okay. Because I think the earnings growth in the coming quarters will justify the valuations. And I think next quarter, market will start to discount FY18 earnings. Right. So when you look at the P ratio from an FY18 perspective, it does not look terribly overvalued.
All right. You're saying that the earnings will start catching up from the next quarter. Where will we first see the pockets of earnings growth?
I think the first pockets would essentially be the commodity intensive companies. Those are users of commodities. They will basically be seeing a full year impact of the savings on their margins. And I think that's
explain that a little bit to our viewers. Just explain that when you say full year impact, you're saying that essentially the lowest price that the commodities that they've taken on long-term contracts, they are going to be the ones that are going to benefit. Is that what you're saying?
Correct. Those who have tied up, in the following commodity thing, they've tied up long-term contracts for, raw materials like iron ore, steel, aluminium, and those which are users of these are going to benefit from the fact that, last year was the trend was down, but the full year impact of such a cost reduction, and I think by and large, corporate India has not passed on this to the consumers, so their margins should see the positive impact.
So essentially, you're saying that because the commodity cycle has slowly started to inch up when we look at steel, aluminum, those who actually have the advantage of having long-term contracts are going to benefit because now while the input costs are rising, the output costs prices will also go up and they'll be able to expand their margin. Is that a fair argument?
Yeah, that's a reasonable conjecture.
All right. So you're saying that there would be some degree of pricing power which will return into the Indian economy, because of which we'll see top line growth and margins will expand. Right.
Yeah, because we're also seeing the consumption start to increase. Nominal private consumption, I think it's its highest in the last decade. In the coming weeks and months, the impact of the positive monsoon and the pay commission and OROP will give a boost to consumption. And when demand is rising, pricing power is always in the hands of the suppliers.
Okay, so when you say that companies which have long-term contracts on commodities, could you give us some examples of, I'm not asking you for stocks, but what kind of companies would be affected, the type of companies?
Well, take auto sector, automobiles, right? They are heavy on input costs like steel and stuff like that. And we are going to see a rising demand for, let's say, two-wheelers, tractors from the rural sector, right? So, and as rates ease, you're going to see, commercial vehicles also get a boost from borrowings. So these kind of sectors, like I said, their input costs, if they are frozen with long-term contracts, with the demand rising curve, pricing power will be at their end. And auto sector is one which will stand to benefit from what I said.
All right. Within auto, again, don't mention stocks. I understand because of compliance reasons you can't. There are some who are rural facing, some who are CV and MHCV heavy, and some which are passenger car heavy. Is it going to be broad based, or would you pick out pockets?
I would say that the first priority would be the rural demand. That's where we see the first tick. The next would be the CV, because freight and transport in rural areas, as a good monsoon is there, and there'll be stuff like fertilizers needing to be moved. There'll be like farm produce needing to be moved. So that'll be the next sector. And passenger vehicles will follow thereafter as people take on when the pay commission comes in, their salaries go up, their borrowing capacity goes up, and then they will go and replace their old cars and buy the fancy new cars. So that will follow. So this is the order in which we see. Rural stroke two-wheeler first, commercial vehicles next, and then passengers to follow thereafter.
Okay, that brings me to the second question, which is that if I am a farmer, right, there have been 2 droughts and there's a good monsoon, I had taken loans which I have to repay, or have to refinance those loans, how quickly will I be actually able to spend on buying a tractor or or buying a new two-wheeler? How am I going to do that, right? I'll probably have to finance my debt first.
Well, if you look at the farming cycle debt, it's essentially crop to crop. So what happens is they generally take crop loans from the public sector banks, and then they take gold loans from the private sector and then they third go to money lenders. So that's where, if you see, the microfinance institutions who have come in have been a great help to the farming community because of the kind of in-between rates that they charge between a bank and a private money lender. So I think those microfinance institutions will benefit from this straight off. The second thing is the Jan Dhan Yojana, and the fact that a lot of the unbanked segment has now, the financial inclusion has really reached out. There were 220 million bank accounts opened. So once you get a bank account open and you have subsidies flowing through that, you have a track record, it's much easier to get financing from the banking system. So I think that their ability to quickly go take a loan from a bank and then refinance their existing costly debt, and then two-wheeler purchases in the rural sector are not so much credit driven as much as they go and pay a lump sum and pick up a two-wheeler. So there is not credit drive needed.
All right. So that would largely be from the more affluent sections of the farmers, you would say, those who have got a bit of cash, especially after harvest. If they're buying tractors and things like that, understandably, financials is one way to play it through, as you said, microfinance institutions, non-banking finance companies. There would obviously also be a higher degree of spending on agri inputs. Would you be bullish on agri input companies?
Absolutely. In fact, we have a dedicated fund called the Rural India Fund, which focuses on all these sectors that you spoke about. And agri inputs are a big part of that fund in terms of its allocation. And already the demand rising for these segments, right, has already led to the fund, kind of delivering something like 17% return on a 1-year basis and 25% on a 3-year basis. So clearly the stocks like agri inputs and all have already started the run up in anticipation of the demand, their growing order book. It's already reflecting on the ground. We are looking very positively at the agri input sector because also in terms of fertilizers, also India's consumption per acre of acreage is still among the lowest in the world. So there's a huge scope to improve productivity through the use of pesticides, weedicides, fertilizers and other agri inputs.
Okay, so would that be, that would include fertilizer companies, that would include agricultural chemical companies, that would include pesticide companies, right? Seed companies.
Absolutely.
I'm not asking for specific names, but I understand that these would be the... But, this brings me to the question that when I look at the entire segment that we are looking at, whether it is auto, especially the rural-focused auto, whether it is the NBFCs, whether it is the gold loan companies, or the MFIs, whether I look at agricultural input companies, seed companies, all of them have run up sharply in anticipation of a good monsoon. Is there still value out there? I know you would have got in early, but is there still value out there to add to your portfolio?
Yeah, absolutely. The reason for that is that, see, the market has really no sense of what is the kind of positive impact. It is just anticipating a certain growth pattern, right? But if you really look at it, you mentioned all factors, but there's one key factor which you didn't mention, which is the 7th Pay Commission and the OROP. See, 53% of government employees work in semi-urban and rural India.
Okay.
Right, and that's about 1 lakh crore. So we are talking about 53 to 55,000 crores of additional purchasing power coming into semi-urban and rural India. So it's hard for somebody to really pick a stock or a sector and say, this is the exact growth that we will see. So the fact of the greater penetration in the banking system, the greater purchasing power, the aspirational value, and the moving of the value chain. See, in rural India, people eat bajra and jawar when they are in the lower middle class. As they move up, they move to rice and wheat. And then they move on to milk and to proteins. So there's a whole value chain which will benefit. It's not possible to just sit down and do a theoretical exercise saying this much will lead to this much. So the market is, in a sense, guessing at this and saying, okay, they are going to do well. But when the actual numbers turn up and they come up, we are confident that the potential is really much higher than what the market is currently anticipating.
Okay, you made a very interesting and important point. 53% of the government employees sitting there, and 1 lakh crore going out. Even if there are slightly lower end employees, well, let's say about 40,000 crores, that 53% takes up. Let's assume that figure. Now, that's a significant amount of money. Even if I look at a savings rate and assume, let's say, that about 25,000 crores will be spent, yes. Would you also bet on, let's say, retail companies, retailers who operate in tier 2, tier 3 towns? Because if they have if the money is going there, maybe they'll go and buy stuff from these people.
No, absolutely, because also if you look at it, coal production, for example, has been a record high. So all coal-based power plants had no shortage. So the electricity generation has been rising. What this means is that even in rural and semi-urban, the aspirational value of stuff like washing machines, refrigerators, which historically were not greatly in demand in those places, is going to rise now, given the aspirational value of this consumer durable space. So yes, retailers who are going to deal in this consumer durables will see an outsized growth demand coming from semi-urban.
And consumer durables, which give you a slightly cheaper range of goods, like cheaper mixies.
Because if you look at it, the brand power of a bigger brand, before it comes to the rural area, the first thing is to go and buy it, to cross that barrier. Yeah. So they will go for the lower end of the price products, because it is the owning that product which is more important than the brand behind the product. Over a period of the next year, 2 years, you'll see people will be going more brand conscious and then going within that to a more expensive brand option. But right at the beginning, yes, it's better to own some mixie rather than a big branded mixie, right?
Right. I'm just going to interrupt you for a second there, Mr. Subramaniam. If you can just, I'm going to continue with that discussion, just interrupt you for a second. If we can just come full frame, because I think we've got those Ambuja cement numbers have come in, and we'll just put up the stock for you right now. I'm just going to try and pull them up for you. The Ambuja cement numbers appear to have come in right now. We'll try and pull them up, but we're just waiting for the details. But let's just look at the stock. That's up about 1.3%. All right, we'll just come back to that when we get the numbers. It's still waiting. We're still waiting for confirmation. Let me go back to Mr. Subramaniam. Mr. Subramaniam, there is one part which I have not discussed, and that is industrials. Now, there is a significant amount of focus that this government is now doing on roads. We've seen cement recovery dispatches have gone up sharply. Power is the distressed assets in power are slightly now playing out. There is some degree of restructuring in loans. People are selling assets and coming through. Is that the argument behind going into industrials?
The argument behind going into industrials is a three-part argument. Okay, the first part is, like you correctly mentioned, the government's emphasis on roads and railways. As you know, in roads, over the last 2 years, we've seen something like, I think in 2014, if I remember right, the per day road laying average was 2 kilometers. Today, they are laying 20 to 21 kilometers of roads per day, right? So one big thing is that. The second thing is, within that, in the road thing, is a big decision of the government, the Gadkari-led ministry, to switch to cemented and concreted roads as opposed to tar roads.
Yeah,
that's one of the key reasons that the cement demand and dispatches are going up. That is the first leg, the government-driven capex. The second capex cycle, which is just beginning to start, is the smaller capex from the consumption-oriented companies, which are putting up small, demand enhancers to cater to the increase in consumption demand. This is not a big thing, but this is the first time the private sector is entering in. You're talking about, consumption companies, FMCG companies, putting up stocking halls, places to stock their goods, investing in distribution infrastructure. So that order book position, if you see in the private sector, is slightly picking up in terms of this small time capex. So that is a wave driven by the immediate consumption need. But the longer term view, if you look at an 18 to 24 month view, because today, you see, whatever we might say about consumption and everything else, private sector capacity utilization is still about somewhere between 70 to 73%, right? So there's a lot of headroom for the private sector for demand to pick up and for the private sector to supply that. Right. So you're not seeing the big capex from the corporate sector, putting up new capacities and all that. is not happening yet. That will, however, begin as we see now the consumption cycle has started with the rural plus the pay commission, monsoon plus pay commission. Demand will go up, let's say 10 to 15%. So that 73% should go up to closer 80% by the end of the year. And next year, as it heads into the mid 80s, with the continuation of the consumption, capex from the corporates in terms of looking at fresh capacity. It takes 18 to 24 months to build up a plant, right? On an average. So you will start to see that 18 to 24 months from now. So that will be a real big boost to the industrials. And I think that the market will start discounting that slightly ahead of that time.
Right.
So I would say
this is the right time to get into industrials, you're saying?
Yeah, but you should do it gradually over a period of the next 9 months, I would say.
All right. Gradually over. All right, Mr. Subramaniam, thank you so much for taking out time for us. Pleasure talking to you. Thanks a lot, and an interesting perspective. Thanks a lot.